on, okay, yes, it is recording now, the Zoom meeting. Okay, you guys able to see the slides, right? So today we're going to cover chapter 3 in our first hour of lecture. The chapter 3, the topic is on cost, volume, profit analysis. It's a very, very basic concept when you deal with managerial accounting. So if you, let's say, try to sell X amount of a widget, right? How much do you have to make in order to break even? Or how much units you make, every one of them can contribute towards the bottom line. Okay, the concept is very easy, but we're going to use this opportunity to reinforce some basic accounting concepts. Okay, so because I believe that most of you have seen this CVP analysis in your 101, right? I think not all of you are from San Francisco State University, but the idea of 305, this is your second cost accounting class, is it? I think most of you are second, this is your second cost accounting class, right? Okay. Is this your first cost accounting class? Can you raise your hand to show me? Oh, some of you, this is your first cost accounting class. Yeah, if this is your first accounting class, it's not a problem. You just have to pay more attention to it. But I think it is easier to absorb some of the idea if you have already taken the first cost accounting class already. But just like accounting 100, right, the basic of financial accounting, you have to take it with the non-accounting students. And the concept covered in the 100 level classes are not necessarily meant for accounting students. So when we deal with the 305, right, the audience is meant to be accounting students. So we had the chance to re-examine the things that we learned from the accounting perspective. I think some of you got that when we went through the first lecture in Tuesday. And today, it's basically the same thing. The material on the textbook for chapter 3, chapter 4, if you look into it, it's surprisingly easy. It's not hard, right? But the problem is for the chapter 3 and chapter 4 is how easy it is to actually fall into the trap, right? Of if you do not think carefully as an accountant. So let's try to get into it here. Okay, let me find my little clicker. So before we start, how's the audio quality? Can anybody hear me all right? Is it too loud? Not loud enough? All right, give me a thumbs up if it's okay. It's okay. Good, good, good. All right, so I'll just keep going. So the first idea we're going to think about is the concept of margin. Right. So when we think margin, okay, what does that mean to you, margin? Right. So the reason why we're talking about this is because as an accounting profession, you will see the word margin in many places. Profit margin, gross margin, contribution margin, margin of safety, right? There are many, many words you will see the margin. So what does that word margin actually mean? Let's think about it a bit. Margin, 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 right? I'm not talking specific about the gross margin or profit margin, right? Or I'm just want to know, let's think about it. What does the word margin mean to you? So let's see, let's find someone. Alexis, help us. What does margin mean to you?
I don't know, but when I hear the word margin, I think of like a space in between two different points.
Space in between. Okay, so you think visually. All right, here is one place, this is another place. So we have a margin of something.
Yeah.
Yeah, that's a good idea. Let me find another one. Let's see. Son, help us out. What does the word margin mean to you?
I pretty much see it the same way. It's just a space between two numbers.
Okay, I want this sentence burned into your head. Over and above. That's what margin actually means from accounting perspective. So every time you see margin in accounting, it doesn't really matter whether it's gross margin, profit margin, right? The implication is that we are looking at something over and above, right? The problem is that when we talk about profit margin, right? The portion, like you said, like Alexis said, like San said, yeah, yes, there's a space, right, implied in this concept, right? But what we are talking about here, the profit margin is a concept that the portion over and above costs and expenses. So visually, we can look at this way. So that's the entire revenue block over here, right? And inside this revenue, what we have some area we account for, that's the cost of sales or cost of goods sold. We discussed last week, no, 2 days ago on Tuesday. So the area over and above cost of sales or cost of goods sold is what we call a gross margin. Sometimes we call it gross profit margin, right? And in this area, inside the gross margin, what do we have to account for? Is the period cost, the expenses, right? Because you see, the cost of goods sold per GAAP rule, this cost of goods sold only include the resources that are dedicated to manufacturing activities. That's the GAAP way, GAAP method, right? So outside here, in these expenses, we captured non-manufacturing activities like administration, marketing, right? Or insurance type of things that not directly associated with the manufacturing activity. So after we take out these expenses inside the gross margin, the area, the portion that is over and above expenses, that's what we call net margin. Okay, and sometimes this net margin is called the operating income. Okay, this is extremely important for accounting students to realize this graph here, because most of the time when you talk to students or business students, accounting students, junior accounting students, or senior accounting students, the ability to distinguish these terms become extremely important. If someone is using the word revenue and income interchangeably, then you know this person is not going to be a good accountant ever, right? Because they are totally different concepts. If you're talking about revenue and profit, they are not different things. They are totally different things. Okay, so to take these 305 classes, this is one of the opportunity you can reinforce your concept, right? The basic concept about accounting terms. Last week, I keep saying last week because I'm so used to the regular semesters. So it's only 2 days ago on Tuesday. And we go through the cost terms, and sometimes you go out and search the internet. A lot of students use the internet as a source of study, or some textbook, or sometimes professionals that they present the accounting numbers in different ways. Like profit margin can sometimes be presented in dollar form. What's the profit margin, gross profit margin? $500,000. Okay, that's good, $500,000. But sometimes it's given in a ratio form and sometimes a percentage form. What does that mean here? Like for example, in dollar form, the gross profit margin is seen as revenue minus cost of goods sold. That's the dollar form, right? But sometimes you see this gross margin ratio. It's calculated as here. Revenue minus cost of goods sold divided by revenue, right? And that's actually what we call the gross margin ratio. The number here shown is a ratio number, is not a dollar amount. Okay, it can also be shown as the gross margin percentage in the percentage form, right? Times 100 here, right? Why is this problem, you think? You see, a lot of times when we use the same word and with different kind of presentation, the problem is that when you run the calculations, you forgot what that actually is. It is a dollar? Is it a percentage? Or is it a ratio? Right? So you have situation like this out of convenience. We professionals or internet sources or some textbook may use the word gross margin for all three forms of presentation. It can be dollar amount, it can be ratio, it can be percentage, right? This becomes a source of common accounting error, especially in, let's say, Excel, especially when you try to put the number together. Oh, you forgot whether this is in dollar amount or in ratio form or in percentage form if you do not indicate it carefully, right? Sometimes we forgot to write the dollar sign here, right? So we just write 20, right? But this number is actually dollar amount. And sometimes we forgot this 0.2 is ratio number, not percentage number. So we know 0.2% and 20% are completely different. But 0.2 in ratio form is same as 20%. So these things, right, you have to think very, very carefully, right? What is the presentation and how to call it? So this apply to all accounting numbers. And a lot of times that student, especially in managerial accounting classes, they run into this error very often. They calculate the ratio, right? But they forgot what they calculate is ratio, not percentage. Okay, or if they calculate the percentage, but they forgot it's a percentage, it's not dollar. So you add numbers together, oh, you are mixing dollar and the ratio and the percentage number all together, and then you get the answer wrong. Okay, and this can be problem even for Excel, because if you just type in the number yourself, Excel doesn't know whether that number is a percentage or that number is an actual number, right? If you type it in, right? Okay. If you use Excel formula to round it up, maybe okay, right? But when the number is not presented correctly, when you don't interpret the number correctly, right, it can be a big source of accounting error. Right? A lot of times when I taught this class in the past, this has always been the common area the student making mistake. It has nothing to do whether they understand accounting or not, right? It's just not being careful, right, to present the number correctly, right? So always attach the dollar sign if it is in dollar form, and always attach the percentage sign for percentage form, okay? And I call it with the right name. Okay. It's gross margin, right? Just call it gross margin. Is implied is in dollar form. It's gross margin ratio. If you want to calculate the ratio, just put the word ratio in it, right? Or gross margin percentage, and you know that's a percentage number, right? Okay. It is not a hard rule, but it makes a huge difference when you communicate with other people, either in oral form or paper form. Right? Just call it tiger. Don't make this type of mistake. All right. Okay, so far so good. Yeah. So now let's take a look at today's main concept here. Today, what we are going to deal with is a concept called the contribution margin. All right, so let's think about there's a space, the final frontier. Right? There's a place we conquered, a place we haven't. All right. So the contribution margin concept comes from, okay, all right, if I'm going to make a bicycle, right, there are certain costs associated with making that bicycle. I need to order the bicycle frame, I need to order the bicycle tire, right? I need to order perhaps various things for the bicycle, right? And this type of cost, it varies depending on how many bicycles I'm going to build. So those costs are variable costs, right? Okay, so if all the parts add up together to 100, and you know that when you try to sell this bicycle, you have to sell it for at least $100, at least to cover your variable costs, right? Okay, so let's say over here. Okay, let me bring up my my writing pads. First, let's draw a bicycle. Very nice color. What does bicycle look like? Ah, that's a bicycle. I'm missing a chair. And that's a bicycle. Very nice color. Something that my daughter will like. So we are saying that all the parts adds up together, all the variable cost associated with that. There are some DM, right? And there are some variable labor. If I need an hour to build the bicycle, I need 2 hours to build 2 bicycles, and so on and so forth. So we figured out all the variable cost to build this bicycle. That's say $100. Okay, and then we also know that by this $100, we know at least we have to sell this bicycle for more than $100 to cover all our costs, right? So if we sell the 200, is that enough? We don't know yet, because what are we missing here? Okay, we are missing fixed costs, right? Because we're talking about building this bicycle. Yeah, all the variable costs are now handled, but how about the fixed costs, right? That the fixed costs that I pay the rent, right, for my factory, the fixed costs that I buy the insurance, right, for this job. So whether this $200 sales price, okay, after considered all the variable costs of $100 is going to cover the fixed costs, this is something that we do not yet know, right? But what we do know is that for every bicycle sold at $200 over and above that $100, these difference here, that $100, the money, this $100 can go to help us make our ends meet, right? To help towards our operating income. Okay, so the idea of a contribution margin is indeed this. Okay, this is the amount remaining from the revenue obtained after all variable costs have been accounted for. Here, variable costs accounted for. Okay, so it can also be seen as this way. It's the excess contribution to the bottom line after all variable costs have been paid. Right. So here, let's take this, still use this as an example. We know for every bicycle sold, I got $100 to pay the bill, right? So let's say if my bill is $1,200, all my fixed, right, is $1,200. And how many bicycles do I have to make? 12, right? I have to make at least 12 bicycles to make up this $1,200, because this $100 contribution margin already covered all the variable costs. Okay, that's the idea. So one thing about the contribution margin is that when you're dealing with the contribution margin, you need to only recognize variable costs and fixed costs. Forget gap. Forget whether it's manufacturing or non-manufacturing. You don't need to worry about that at all. Just variable and fixed. Okay? We don't even consider whether it's manufacturing or non-manufacturing. This is not for financial reporting purpose at all. We are just doing this to see how every bicycle that we made, right, after all the variable costs is being taken care of, can we have money left, right, to contribute towards our bottom line, right? So this is a common point of confusion. The students say, oh, okay, this is manufacturing, this is non-manufacturing. It doesn't matter when we are dealing with the contribution margin. We only separate the cost into two pools, variable cost pool and fixed cost pool, okay? And the part over and above all the variable costs, that's what we call the contribution margin. All right, hold on. Okay. So to calculate it, this is this way. The amount remaining from revenue obtained for all variable costs have been accounted for. So we have a formula like this. The total contribution margin equals to revenue minus the total variable costs. Okay, so that's what we see the formula here. And this formula is important. One of the common theme that is plagued manufacturing accounting or cost accounting is that students think there are so many formulas to remember. You probably remember from your 101 class where you're dealing with the contribution margin or the CVP analysis. You try to memorizing all the different formula. Just like the cost of goods schedule we deal with on Tuesday. Some students try to memorize or write down all the formula. Don't do that. Just one formula to rule them all. Okay, one formula to remember. That's this. Total contribution margin equals to revenue minus total variable cost. That's it. Just remember this number. And all the other formula, they are just algebraic exercise that change the things around, right? Move the things around, right? But it all comes from this formula. TCM equals to revenue minus TDC. Total variable cost. Just put that picture in your head. Revenue, variable cost, fixed cost. Revenue after take out all the variable costs lumped together, we get the total contribution margin. How much contributions has this revenue made after a variable cost has been taken care of? Okay, towards our bottom line. Right. So, like I said, I promise you that the one formula will rule them all. Yeah. We can extend that. Okay. So, if you want to calculate unit contribution margin, right? All you need to do is divide it by the unit sold. This total contribution margin here, divided by the unit sold, you will get per unit contribution margin for every unit sold. How much has it contributed towards the bottom line, right? So if you take UCM, unit contribution margin, times your volume, the unit sold, you will get total contribution margin, right? Okay, or we can do it this way. Unit contribution margin equals to unit selling price minus all unit variable costs, right? Just like the earlier example we did on the bicycle, right? We have the unit selling price of $200 and we accounted for all the variable costs that can be traced to that unit and we get the unit contribution margin. So same thing here, the unit selling price times the sales volume, what would that give us? Revenue, right? That's just how simple and straightforward it is. Okay, so that's so good. Is it too fast, too slow? Okay. All right, I guess it's okay. So if we think a little bit more on the contribution margin, right? One thing we look at it is we call the CM ratio, right? Remember earlier we talked about margin and then we talked about ratio. Okay, so the CM ratio is the unit contribution margin divided by unit sales price, right? But if you think about it, right? Wow. This is the same thing, if we consider the volume into it, we can also use total contribution margin to achieve the same ratio, right? Yes, here. Total contribution margin divided by revenue you will get the same contribution margin ratio, right? Why is that? Let's take a look over here. Oh, that's my bicycle, right? Let's forget this bicycle. So mathematically speaking, right, you have UCM over USP, unit selling price, right? So if say that say volume is 10,000, right? This will be the total contribution margin, and here unit selling price times the unit times the volume. This will be revenue, right? So these two things are exactly the same, right? Because they are multiplied by the same factor, the volume, right? So some students struggle, you know, wow, the CM ratio, what is it, unit price or total revenue here? No, just try to understand the underlying principle, then you won't forget. So what does this ratio number mean then? It means out of every dollar, okay, made in revenue, how much can contribute it towards paying the fixed costs and contribute towards the bottom line, right? So because what? You are doing this as a ratio form, right? Do you guys understand when you do this, what happened? You see, so if you times like 20 divided by 5, what do you get? 4, right? Right? So that means it's 4 over 1. That's actually what it is. So if you read the 20 divided by 5, that means that every person get 4, right? So the same thing here when you're doing contribution margin in a ratio form, right? What you effectively doing, let me clear this canvas so I can show you. So you see, okay, let's say if the total contribution margin is 40 and your total revenue is 100, right? So that means your CM ratio is 0.4, right? Okay, and just exercise this sentence. Out of every dollar, $0.4, okay, can be used towards paying our bottom line, right? Okay, so from this perspective, we know 0.4 times, if our revenue is 20,000, right? And then our contribution margin will be 8,000. Okay, so that's what ratio form means. Ratio. When your denominator become 1. Okay, when you do 40 minus 100, right? This equals to 1 over 0.4. Okay, that's what division means. Okay, right, so you see, okay, for every dollar we made, $0.44 can be used to pay my rent, okay, to pay my car, to pay my various things. Okay, that's what CM ratio implies. So if you write in percentage form, 0.4 is how many percent? 40, right? So what does percentage form mean? So 40% of our revenue, okay, can be used towards paying the fixed cost because all the variable costs has already been accounted for, right? So that's what percentage form mean, right? So that's why I try to encourage you guys, really, when you use the presentation or when you talk about accounting numbers, right? Use the right one. Use, if it is ratio, think ratio, right? If it is percentage, think percentage. If it is dollar form, think dollar form, because it matters when you are doing your calculation. All right. Okay, so next. Where's my... So after we understand the contribution margin, right, just like earlier we discussed, right, the idea of making ends meet. Okay, so towards paying the fixed costs, paying the rent and all that. So those type of exercise is what we call a break-even analysis. Right? So what is meaning of break-even? Think about it a bit. What's the meaning of break-even? Exercise this idea a little bit. Break-even. How do you define break-even? So Michelle, help us out. How do you define break-even?
Isn't it when it's like equal, balanced? Isn't it when it's like equal and balanced?
Break-even, yeah, you can't imply that something is balanced. But in accounting, when account is balanced, right, there are different meanings. But when we talk about break-even, it means something very, very specific. Okay, so if we think about break-even, right, think in terms of this. You are just making enough money towards making ends meet. That's it, right? If you think about making ends meet, what does that mean? Well, let's say, look at what we're living right now. Some people have a very difficult life, right? They every month they have to pay rent as a student, right? And they get this part-time job here and there. They still have to eat food, right? So in their life, there is like a portion of variable costs. Every day that I go on to live my life, I have to buy food, right? On top of that, every month, I have to pay a fixed portion of rent, right? So how much do I have to make in order to make my ends meet, right? So the point when you are able, just make enough, barely enough, right? To make your ends meet. That's what we call break-even, right? This is understood in a very plain English way, right? But this is not enough, right? We are accountants, so we have to look at things in accounting form. So what is that? In accounting, the break-even point is meaning that when operating income equals to zero. Right? Remember earlier, how do we calculate operating income? Revenue minus what? Cost of goods sold, right? And then minus what? Expenses, right? That will give us operating income, right? So some of you may think, how about tax, right? If you're not making any operating income, you're not paying any tax. Don't worry. So you don't need to calculate tax here, right? So before thinking about tax, your operating income is already zero, then you're not paying any taxes. So in accounting terms, right, the break-even point, what is break-even? Is literally meaning your operating income is zero. You made nothing after paying all your cost of goods sold and your expenses. So it also means that your total benefit obtained equals to your total resources sacrificed. Okay, I have just got enough from selling the bicycle, right? Total benefit to the total resources that I sacrifice. Some of the resources require actual money to pay for the rent. Some of the resources include other things, right? So think like this. Oh, I got $100 benefit from doing something to do my nanny job. Right? Did you guys ever get like getting paid as nanny? Right. Like, so the more hour that is used towards taking care of the kids, the more money you get, right? But yet in the same time, every time you drive to that home, you have gasoline to pay, So if you think about it in that term, yeah. Or we can think about in terms of the lemonade example that we thought about last time, right? If the total benefit we received is $100, and everything that we put together to make that lemonade is also $100, then we have break even. We didn't make any money at all. That means break even. Okay? So that's okay? Yeah. So break-even analysis, if we use income statement method, this is important. The income statement method means the traditional method. We are using the GAAP numbers, separating manufacturing and non-manufacturing number. That's when we have cost of goods sold and expenses. Because cost of goods sold only include manufacturing related costs. And expenses, they are period cost, right? They are washed away every period. So if we use income statement method, what we see here is here. First, revenue minus cost of goods sold, we get what? Gross profit or gross margin. And then the gross profit, we minus the operating expenses or period cost, right? We get our operating income. Okay, so we know from this over here, the revenue minus cost of goods sold plus operating income, these are our total costs, full costs, right? Equals to operating income. We just move things, move the number around. We get that, right? And when operating income equals to 0, what will happen? The gross profit will be equals to operating expenses. Over here, did you see this line here? If operating income equals to 0, okay, you guys may not be able to see. So let me pull up my pen. Where does my pen go? Oh, my pen disappeared. Huh. Sorry, I'm looking for my pen. No, I can't find it. Oh, I'll find it later. Okay, so take a look at the second line here. If we say operating income is 0, right? You move operating expense over to this side of the equation, you will get gross profit equals to operating expenses. So what does this mean actually? Right? That means, oh, at this point we have break even, and over here, so when the revenue equals to cost of goods sold plus operating expenses, over here, if operating income becomes 0, the benefit that you received, which is revenue, the resource you have sacrificed over here, cost of goods sold plus operating expenses, is this thing equals to each other, we have break even. Okay, so that's the income statement method way of looking at break even. Okay, the sentence that you need to remember is operating income equals to 0, right? The others, they are just an algebra exercise, right? Over here, the second line, you can see that when operating equal to 0, right? Gross profit will equals to operating expenses. That's the break-even point. Okay, and the same thing when this operating income equal to 0, the revenue will equals to cost of goods sold and operating expenses. So theoretically, all these means the same thing, that the total benefit received equals to resources have sacrificed. All right? Okay, so then let's take a look at the contribution margin approach. So you see, in the income statement approach, we are separating cost of goods sold and operating expenses. Why? Because cost of goods sold, they only allow manufacturing related activities, right? And expenses are non-manufacturing, right? But in CM method, the contribution margin method, we only consider 2 cost pools, which is what? Variable and fixed. Right? So if we take a look at that, same. We know COGS plus operating expenses equals to full cost. We can also take a look at the full cost in a different way. The total VC, total variable cost, plus total fixed cost. That will give us the same full cost. We are just looking at the different cost pool. So we know from here, the revenue minus total VC plus total FC, fixed cost, will give us our operating income, right? Okay, so when the operating income equals to 0, what will happen? Revenue will equals to total variable cost plus total fixed cost. Right? What does this mean, this sentence? Right? The benefit received equals to the resource that I have sacrificed. Right? And earlier we have already learned revenue minus total VC is what? Total contribution margin. Right? We learned this formula earlier. That's the one formula that I want you to remember. So we know the total contribution margin, when it's equals to total fixed cost, we have break even. Right? You see that? Over here, you just replace things around. Right? You guys see that? Over here.
Yes.
You move the VC over here, total VC over here on this side of the revenue. Now you got revenue minus total VC, and that give you total CM, contribution margin. So if total contribution margin equals to total fixed cost, you have break even. So what does that really mean? Right? It means that after all my variable costs are taken care of in our earlier bicycle example, right? The parts, the labor, the variable cost is $100. And I can sell the bicycle for $200, right? So for every bicycle sold, I got $100 to pay the bill, right? So if my fixed costs are $1,200, right? I make 12 bicycles, then I break even, right? So that's what break-even analysis, right, is done using two different methods, the contribution margin method or income statement method. The problem why students usually make mistake is they are mixing numbers between these two methods, right? Remember that in contribution margin, we only deal with variable costs and fixed costs, two pools, that's it. In income statement method, we're dealing with cost of goods sold and expenses. We're dealing with manufacturing and non-manufacturing, right? A lot of times the student mix the number back and forth, right? So they think, oh yeah, when we're taking the lecture, it's easy, I understand, right? But when they're doing the exercise, they, oh, right? Because they did not distinguish whether it is a income statement method or a contribution margin method. Okay, so far so good. All right, let's take a short break. I know it's a lot to take in, right? I try to do this slowly so you can understand in how to call that? You can understand it better. You know, not just try to absorb, but try to memorize it, because it's not good. Try to memorizing this formula. It doesn't work that way, right? Okay, so we'll come back and look at the different uses of the contribution margin approach. We can use it to do many things. So I'll look for my pen, and let's take a 10-minute break and come back at 7 o'clock. Is that all right? Yeah. Huh? Yeah. Yeah.
Oh, wow.
窓閉めてみんな。窓閉めて。いい子窓閉めて。自分の部屋とか。
Dirty country, don't wear a mask and then don't keep yourself at a distance. Don't wash, don't take a shower every day.
Mama, do you know where's my phone? I need to scan something. Okay. 네. Okay.
All right, let's come back to class. Oh yeah. Let's go back to the last slides here. There's one thing very important I want to communicate to all of you. Right. So sometimes some students take things out of context, right? And then they said, Professor, you write that on your slides, and I use your formula, and it's wrong. The type of student I'm referring to is saying, oh, Professor, you said the revenue equals to total VC plus total FC. That's the revenue. Is that true? No, right? The condition is here, right? When operating income equals to 0, revenue will equals to total FC plus total BC. The condition is here, right? But you cannot take this one out of context and say, oh, the formula of revenue is total VC plus total FC. No, it's not, right? Because this only happens when operating income equals to 0. The true formula is revenue equals to total VC plus total FC plus operating income. Okay? Don't when you read things, read carefully. Don't take things out of context, especially in managerial accounting. All right. So let's think about the use of the contribution margin approach. The contribution margin is really useful in cost accounting, and you will see contribution margin over and over throughout the rest of the class and in later chapters. And a lot of times that you will need to calculate contribution margin because knowing that how much a unit contribute towards paying the bottom line is very useful in many type of calculations. So that's why I'm trying to spend so much time try just cover this ground on contribution margin because I want you to understand the concept behind it. So if we want to analyze the break-even volume, that means how many volumes, how many bicycles or how many cups of lemonade we have to sell in order to reach that break-even point. You can use this contribution margin approach as well. It's very easy to do it that way. We already know that total contribution margin, when total contribution margin equals to total fixed costs, we have break-even. right? And we also know that the unit contribution margin is the unit selling price minus all unit VC, right? So if you put this 2 and 2 together, we know if your fixed cost is $1,200 and unit contribution margin is 100, right? And you can just divide them to get your break-even volume or break-even units, right? That's just how easy it is. Earlier, we already go through that bicycle example. We have a fixed cost of $1,200 and unit contribution of $100. So we know we need to make 12 bicycles, right? And that will be our break-even volume, right? That's what it is. All right. So the next one is what we call the margin of safety. You see the word margin again, right? Okay. So here, margin of safety, just use the same concept that we go over earlier, the concept of over and above. Okay. And margin of safety is this thing that the dollar amount over and above, over and beyond the break-even point. That's your margin of safety. Right? You can calculate it this way. Margin of safety equals to your total contribution margin minus the total fixed cost. Right? So that means how much money you can afford to lose, right? Before you get to the break-even point. Right. So let's say if my total fix is $1,200. Now, let's just keep using the $1,200 here. Right? And then my total contribution margin is $1,500. So my margin of safety will be $300. I can afford to not make $300 and still stay afloat. That's the idea of margin of safety, over and above the break-even point, right? Your room, the wiggle room. I don't have much aspirations. I just want to be a little bit above break-even. That's it. So that's what margin of safety is for. How much room do you have before you fall below the break-even point? Right? You're not making any money anymore. That's the break-even margin of safety is for. And also, you can use contribution margin to calculate the target volume, right? The idea is this: the target volume is equals to the total fixed cost plus the target profit you want to reach. Okay, earlier we already talked about, right? My total fixed cost is $1,200. If I want to make a profit, right, of another $1,000, that would be my target profit, right? Then that will give me the profit, the revenue that I have to reach, and divided by the unit contribution margin, then again, we will get the target value, right? Okay, we already go over this break-even unit, so that, but it's not break-even unit, it's the break-even revenue. I'm sorry, I'll make the correction here. The slides here, it says break-even unit. It's supposed to be break-even revenue. Okay. So the break-even revenue formula look like this. You see, total fixed cost divided by CM ratio. If you look at this formula, you would be like, what? Why? This is a ratio number. Why we divided with that ratio number? So if you try to understand it this way, okay, revenue times the contribution margin ratio, right? Okay, equals to the total contribution margin, right? Okay, so if TCM equals to TSC, we have break even. So how that works is this way. So on this side, we have revenue. Right? So if we times the CMR on both sides, so over here on the left hand side, revenue times contribution margin ratio, we get TCM, the total contribution margin. And over on the right side, we have the total fixed cost. Therefore, again, we have seen the point, we have gotten the point that the point of the revenue that we have to make in order to get to break even, right? So that's what break even revenue is. The dollar amount you must make, okay, in order to break even, right? So far so good? Right. So any questions about contribution margin? So you see, the in the textbook practice question, a lot of them use contribution margin, right? And if you understand contribution margin, you can just do all those questions. It's not easy, but how do I put it this way? I really would encourage you to go over the contribution margin concept, right? And how to use the contribution margin over and over. You really need to understand this instead of just memorizing the formula, right? It will help you quite a bit in the long run, all right? Okay, any question about contribution margin? Or the break-even analysis? No, eh? Okay, so I think somebody typed a something in the chat window. Let me try to get it. Oh, okay. I got. It's just somebody's late. Ivy, right? So, all right. So that's chapter 3. Let me move on to chapter 4. Now I see a lot of you are eating. You need some time to finish some food. Yeah, let's go get some food. How about how's that? Then we'll come back in chapter 4. Yeah, let's do that. Let's do that. Let's and I'm also very hungry. I need some food as well. Right. So let's come back 7:30 so we can all get some food.